Hi everyone, Buyer's Agent Jay Pace here for Providence Property Group with a market update for the month that was November 2023. Now this is my last market update for the year. I will be back with a December/January mashup wrap in February. So let's just jump in and start talking about what happened last month. So after falling 7.5% from a peak in April 2022, the market overall, to about a trough in 2023, and then we started seeing a rise. Housing values have definitely bounced in a bit of a V-shape like recovery. So we've seen about an 8.3% jump up. So 7.5 down, 8.3 up. So very much a V-shaped style recovery. Last month, I broke down the numbers as to what's happening every single week. And let's have a look at it right now and see what's going on. So we can see here that the Sydney market has increased in value by $102,000 from January 1st to November 1st, which is about 47 weeks. And that's $2,400 per week increase. Then we've got Perth at $87,000 increase or $1,900 per week. Brisbane at $83,000 increase or $1,800 per week. Adelaide at $53,000 increase or $1,100 per week. And last, Melbourne at $23,000 increase or $500 per week. Now, remember, these are averages, so there's markets within markets. We've bought in some suburbs that performed well above this, but there's also suburbs that have performed below this as well. But if we don't use averages, what are we using? So this gives you a good idea. Now, if you are someone that's sitting there saying, we're just going to wait for a little while, we're going to save some more money, we're going to see what the RBA does, we're waiting for more of that stock to come on board and for everyone to have to sell their properties and me pick up a bargain, that's not going to happen. The thing that you've got to remember is the average Australian household saves about $400 a week. So even with the worst performer right now, the fifth place performer, Melbourne, it's still outpacing you by $100 a week in regards to performance. So you've got to have a look at that and make sure that you're not wasting your time and looking for a unicorn. Now, my team spent a lot of time in their cars going to open homes. And recently, from some of the photos I've seen, I feel like the cars that are going to some of these auctions and these open homes look more expensive than some of the houses, actually. SQM Research has released their annual Boom or Bust report, which forecasts falling home prices for 5 capital cities next year in 2024, alongside the strong possibility of a negative end-year result for property prices. Now, SQM predicts a 1 to 3% drop in the value of the median dwelling across the Australian capital cities. Now, based on that current price, I did the calculation. It would only be a worst case scenario of a $25,000 drop in price. Although I don't agree with everything they report, one thing that I do agree with them on is their forecast that we will see prices continuing to increase in Perth and Brisbane, with both markets being propelled by a recovering Chinese economy that is expected to increase demand for base commodities like iron ore and coal. So I think that's quite interesting. And you can go and get the report online. Now, looking at the Hedonic Home Value Index findings for the 1st of December, we can see again in that annual column there, which you can see in the middle, Perth, best performer, up 13.5% since January 1st. Brisbane actually overtaking Sydney now in second place at 10.7%, and then Sydney dropping to third place at 10.2%. The total returns column, which is the one to the right of that, you can actually see the capital growth plus the rental yield, okay, which is why 18.9% in WA is definitely quite attractive. Now, if you've been watching our videos for a while, you will know that Linton, Simon, and myself do not buy in regional areas. We believe buying in these areas is a major roll of the dice with the odds significantly against you. And unless we're getting a pandemic or a global financial crisis or something that upset the apple cart, we're not seeing a significant change in these areas. Based on that, here's the data that backs up that claim. New national forecast data from PEXA and Informed Decisions together finds that the regional renaissance has ended. I get lots of clients call me up at least every week asking me, hey Jay, I'd like to buy in this regional area, etc., etc. Now, the report's findings describe that the regional growth that we saw over, the period of, 2020, 2022, was caused by an interruption to what they labeled regular programming. Now, what is regular programming? So typically regional areas lose population, mainly young people moving to larger cities, resulting in an aging population because everyone that stays there is old, and declining population. Now, in 2020, COVID and university lockdowns created an artificial dam in these areas, slowing the drop in population. So most of the growth in regional areas experienced during that time was not from people coming, but from people not going, from people not leaving. And the report claims that the COVID-inspired rush to these regional areas, over 2/3 of Australian population growth in the next 2 decades is going to be concentrated in the big 4 capital cities, Sydney, Melbourne, Brisbane, and Perth. So the report claims that that COVID-inspired rush to those regionals is over. Okay, that's what it claims. And I think that's pretty straightforward. Now, let's break down some more of the data. The national population is forecast to be 7.4 million, to increase by 7.4 million by 2041. So they're expecting an increase of 7.4 million people in Australia by 2041. And that's requiring an additional 2 million dwellings across our 4 major capital cities, which will account for over 65% of forecast population growth. Now, the 4 largest states will receive 93% of Australia's forecast population growth by 2041, with 4 capital cities receiving 67% of the total growth. Now, Victoria's population is forecast to add 2 million people, with 1.6 million occurring in Greater Melbourne. New South Wales population is forecast to add 1.7 million people, with 1.2 million occurring in Greater Sydney. Queensland is forecast to add 1.6 million, with 1 million people occurring in Greater Brisbane. Western Australia is forecast to increase by almost 1 million people, 0.9 million, which is 0.8 million, occurring in Greater Perth. And Tasmania is forecast to face a demographic imbalance problem, with young people once again leaving to go to the mainland and people in retirement age groups continuing to move to Tasmania. This is a similar story what we see to all regional areas. And even though Tasmania is a capital city, it acts like a regional town, okay? Sunshine Coast is forecast to triple its retirement-aged population over the next 25 years, caused by a combination of migration from other regions and states and the current population aging in place itself. Now, even though Old Albo says everything's going to be fine, PEXA says the 4 hotspot cities which will receive most of our new migration require vast numbers of new homes. And we got the numbers here, 723,000 new homes in Melbourne. So that's 40,000 new homes per year, or 772 new homes per week, all right? Sydney, 582,000 new homes. 381,000 are required in Brisbane, and Perth needs 344,000. Now, Adelaide is going to require probably one of the lowest numbers there, 141,000 new dwellings by 2046. So I think we just don't have enough new product. If we do look at the total listings rolling 28-day count for the combined capital cities, again, we will see that the amount of stock is starting to come up, which is great. All right, I'll move my head out of the way so you can see where we are. So the amount of stock that we've got is coming up to similar time last year. We're still 2.2% below the same time last year, but we are still 12.9% below the 5-year average. So if you're one of those people that's expecting all this new stock to come on board and bring property prices down, you know, Australia can't build enough stock to do that in the first place. Rents are still rising. Perth's taken the crown still for annual increase for both houses and units there. 12.9% increase this year for houses in regards to rent, and 16.3% for rent in units. So I think that's quite interesting. Now, if we do have a look here at gross rental yields for dwellings, and why do I always talk about this? Rental yield is the income that you receive for holding on to an asset. If you've got incoming and outgoings for your asset, treating it like a business, you want to know, what am I making versus what's it costing me to hold? So if the average income is 3.5% of the value of the property, but the average outgoing is 6.5% to 7% based on the current interest rates of property, straight away we're in negative territory. Okay, and this is probably another reason why we're seeing people moving their money from the lower rental yielding states like Sydney and Melbourne and moving into places like Brisbane and Adelaide where you're getting 4.6% rental yield. So that makes a lot more sense in my eyes. We continue to see rental vacancy rates drop. We're now 70% below the 10-year average of 3%. So, that's definitely not a good thing. The RBA met yesterday, so let's have a quick look at let's look at this kid's face because I think he's cute. The RBA met yesterday and came out with the data and their recent update. So the RBA's board decided to leave the cash rate alone, so they've just left it alone right now at 4.35%. We're still at a 12-year high. We've had 13 interest rate rises since May 2022. Now let's have a look at some recent purchases before I kind of wrap up here. We've been extremely busy. Usually things drop off after Melbourne Cup Day, typically from my experience, but we've just been getting smashed, which is great. I've been telling people don't wait, so maybe they're listening to me or maybe someone else is telling them something. Often we get clients wanting a property in a superior location with the opportunity to add some value. So our client who purchased this property was actually based in Brisbane, which is great. So we got to work really closely with this client, with our local team that lives there. And they found this project home that suited his abilities and his aspirations. The client plans to actually live in the property while he's updating the home, and then he's going to pull equity out and we're going to keep buying property. So he's got a pretty good hands-on strategy here. It's a 3-bedroom, 1 bathroom, 1 car space house. It's a real perfect example, actually. It's in just a superior location. Our team valued the property really accurately, and we told the agent that there was, no sales to really support their original asking price, which was a tad over what it should have been. And, we said that we were looking at another property in the area, so we did a bit of bluffing and a bit of strategy, and we secured the property for $1,085,000. Now, the original owner was actually seeking $1.15 million. So same size vacant land has now sold for 1.15, so nearby. So we were very happy with the price that we negotiated and now what it's worth today. We had rejected many properties before kind of settling on this one due to very high land asset ratio, which is perfect fit for the client's high capital growth brief that he provided us with. I mean, something like this equivalent from the CBD here in Sydney, 7Ks, you're talking $5 million for a knockdown. So I think it's really interesting. Look at that block. I mean, it's perfect for a duplex site. It's just a really nice block in itself, so we were very happy with it. So let's look at the numbers quickly. 7 kilometres from the CBD, $1,085,000 purchase price. Conservative rental yield, again, he's not renting it, he's going to live in it, but conservative rental yield is going to be around about 3.1%. Remember, we're not buying this for income. If we wanted to buy it for income, we'd buy a different property, we would have spent less and we would have a higher rental yield. But this client's focus is capital growth. Why we love this purchase: top location, north aspect to rear, strong historical growth performance, high quality blue chip suburb, access to cafes and public transport. It makes sense. Perth's definitely become a real popular destination for our clients seeking a balance of income and growth. So our client wanted low maintenance and modern. We bought this 5 years young house on a 560 square meter block. I mean, 5 years old. How amazing. It's a modern 4-bedroom, 2 bathroom, 2 car space house. And we got it, I can't tell you the suburb. Oh, I will, it's Christmas. We got it in a suburb called Caversham, and which is to the northeast. And the house is located in a private estate. It's extremely functional and modern with big open plan office and workspaces. The location is great. It's surrounded by a host of amenities, including local shops, schools, parks, and public transport. The distance from the CBD, 13 Ks. Now, we got this for $775,000. It's fantastic. It's within less than that 15K mark. It's under $800,000. We're going to get about a 4.6% rental yield for about $700 a week. Great backyard, nice block of land. It's young, it's modern. The home requires minimal maintenance, easily rentable, decent land component, high income demographic location. It just all makes sense. It's an ideal investment property. This one's kind of right up my alley. It's not as attractive as the last one, but if you remember the property that I bought in November last year, and I did a video about it in May this year. If you haven't watched that video, go back and watch it because I do a full breakdown of my strategy. But it's got a large land component. It's nicely renovated. It's the type of property that you can easily sit on for a couple decades in this location while the other older houses in the street are going to get knocked down, subdivided, rebuilt, allowing you to benefit from an increased housing price. So check this one out. They did a really good job. This is a 1970s build, which has had a total internal renovation in 2019. They did a great job. Like I said, if you watch my video, there's a lot of similarities between this one that I bought for a client and the one I bought for myself. This is a classic 3-bedroom, 1-bathroom, single lock-up garage. One of the questions that we ask clients when buying an investment property is, would you prefer an older house on a larger block or a younger house on a smaller block? And listen, there's pros and cons to both, and the decision it often comes down to the buyer's personal risk tolerance level. If you and I have that discussion, I'll explain all the pros and cons. I don't have time to do it here, but I think it is important to look at. It's often about finding the balance between that cash flow, which is on the left-hand side there, and obviously that capital growth on the right-hand side there. So one is instantaneous, the cash flow, you're going to get it as soon as you rent it. The other is more long-term. So it depends on how you're thinking about your investment strategy. Again, 9 kilometers from the CBD. This is a really decent sized block that you can see there, 728 square meters, $710,000 purchase price. I mean, again, which is what a great property. It's got a strong growth location, large government infrastructure spend in that area, super tight vacancy rate, low maintenance, potential development site. It just makes a lot of sense. Lastly, as I said, we can't help you until you commit, and once you commit, we won't let you fail. We're buying two things together here. Where your desire to build wealth and our 18 years of experience. So we're bringing those two things together, and hopefully we can obviously assist with you. For more than 3 decades, Providence have helped Australians open a life of opportunity through real estate, giving them the future that they want. We buy unique quality assets in areas where demand outpaces supply. We focus on property that appeals to a much larger market of owner-occupiers, so 70%, not just that 30% little investor group. And we buy in the right capital cities at the right time, guided by the economic property cycle. And we've got so many videos on the property cycle, watch them. We buy the property which is uniquely suited to your situation, which will act as a springboard to your next wealth building stage. This is how top performers buy property. This is how the top investors invest. So if you've liked what you've seen here and you want to be kept in the know with the Australian property market, make sure you like this video, subscribe so that you get notifications. If you want to further your education, you can download our free ebooks. The links are in the description below. I want to thank you for your time today. I will see you in February 2022. Merry Christmas, Happy New Year, all that stuff. Enjoy the festive season. Enjoy time with your family and your loved ones. Thank you.